John Jannarone, Heard on the Street team. John, would you short Michael Kors stock today?
It's a tough question, but I'd be much more likely to today than I was a couple days ago.
Now, why is that?
Well, as you said, I mean, that number is huge for a company like this.
It's trading at what, 60, 50 times earnings?
It's 50 times consensus earnings for the year through next March 2013. Now, but you know, my issue, and I think that a lot of people look at things this way, is that you've got to find more. You can't just say the stock's expensive because there's so many stories.
There are lots of expensive stocks out there that have stayed expensive for a very, very long time. Amazon, Salesforce.com. I mean, there are companies that have had this premium for years. And so valuation in and of itself is a tough way to make a living shorting stocks.
Yeah, exactly. Now, I think that things changed a little bit yesterday when, or I'm sorry, it was Friday night, when we learned that some of the insiders had gotten a waiver to sell stock before the typical 180-day period after the IPO. Now, bear in mind, when this company went public, it wasn't issuing new shares. Insiders were selling already. They sold, you know, let's see, you know, roughly a quarter of the company's shares.
They sold the car, and just so we're clear, so the company went public. I don't know whether it was priced at $20 a share, but it came out. It was priced at $20 a share, and the shares are now trading up
almost at 50.
Almost at 50. So you would have made, you know, 1.5 times your money on that trade alone.
Yeah, in less than 3 months.
Very, very short period of time.
Yeah.
And so the insiders naturally going, geez, we're owners of this company. If there's such a demand for the stock, why not sell our stock? What's the problem with that?
Well, in my eyes, the problem is that the market wasn't expecting this because there was an agreement. Now, if you look at the document itself from back in December, the underwriters have complete discretion. If they want to give the green light to the insiders, they can do that. But it's very rare. It doesn't happen much. It happened last year with Dunkin' Donuts, but aside from that,
in that case, you had some private equity firms that were looking to get out.
Yeah.
And in the case of Dunkin' Donuts, I think the share prices also had done very well coming out of the gate. So for the existing investors, they kind of had the opportunity to sell the shares, so they couldn't point the finger at the selling shareholders and say, you know, you didn't tell us this.
Right, right. You know, Dunkin' Donuts hadn't done quite this well, though. I mean, it did well in the very beginning, and then it kind of, you know, hummed along. But you know, this is a little bit worrying because you've got to ask, you know, what do these guys know? And
what do they know that Michael Kors now has a valuation of $10 billion, which is a lot for Michael Kors. Now, do you own any Michael Kors products? You're a bit of a fashion maven.
No, that's not my thing.
That's not the way you roll. Not
my girlfriend's thing either. She likes Reed Krakoff.
Yeah, I don't know who that is. But have you ever been to a Michael Kors store?
Yeah, sure.
Yeah, you have. Just never really pulled the trigger on buying anything.
No.
The trouble that you have, and maybe I have, is not so much that we know for a fact that the company's overvalued, but if you look at a company like Ralph Lauren, which has been around for, well, as a public company, it's been public for more than 10 years, almost 15 years, I believe, and that company's got a market cap today of around
14 or 15
billion dollars. So you're saying, you know, maybe Michael Kors needs a little more of a track record to get those kinds of valuations.
Yeah, absolutely. And you know, just one thing a point I'd like to make. You know, I wrote about this company twice before, and I was positive for the reasons we just walked through. But you've got to bear in mind that these IPOs are managed very, very carefully, and I think that the odds of this company missing numbers anytime, you know, within the first 2 reporting periods were very low. But you know, if people start to realize that the company is managing expectations extremely carefully, you know, it's possible that the market is, you know, catching up. Yeah, it's catching up with, you know, what the numbers are actually going to be. And so, yeah, at this point, I'd say if you owned it, you know, it's been a great run.
Maybe cash in some of your chips. I mean, these things, they do have a tendency, you know, they grow in. You know, once the valuation gets ahead of itself, it may not be that the stock cracks, but it may stay where it is for a very long time.
That's right. Yeah. So, but again, shorting it is still dangerous because
very dangerous,
and virtually no one has.